Accounting terms every smart person should know. 401k. A 401k is an employer-sponsored retirement savings plan in which taxes are not paid when the money is put in, but when withdrawals are made on the account. Some employers also offer Roth 401ks, enabling the money placed in it to grow tax-free. Accounting. It is the systematic recording and analysis of the financial transaction of a business. Accounts payable, AP. Accounts payable refers to money that a company owes to another party. In accounting terms, the entity the money is owed to is a creditor. Accounts payable include virtually all expenses accrued by a company, from payroll to material acquisition, and explicitly encompasses expenses to be paid soon. Accounts payable. It is an aggregate amount of an entity's short-term obligations to pay suppliers for products and services that the entity purchases on credit. Accounts receivable. This is the money due and owed to a business by its customers. Accounts receivable. Accounts receivable is the inverse of accounts payable and refers to money that another party owes the company. Like accounts payable, accounts receivable are due to your company in the immediate future. Therefore, a company with whom you have an accounts receivable is a debtor. Accounts receivable, short-term amounts due from buyers to a seller who has purchased goods or services from the seller on credit. Accrued expense. Accrued expenses represent amounts owed for expenses that have been recorded but have not yet been paid. Examples include interest, salaries and wages, and potentially income taxes. Accrued expenses. This expense has been incurred but not yet paid. Asset class. An asset class is a grouping of investments that exhibit similar characteristics and are subject to the same laws and regulations. The most notable asset classes are stocks, bonds, and money market accounts. Asset. An asset is an item of economic value that is expected to yield a benefit to the owner in the future. Assets could be anything from a building to an office chair. The value of a company's assets is reported on balance sheets to help accurately assess the company's value. Balance sheet, BS. A balance sheet is a report that summarizes all of an entity's assets, liabilities, and equity at a given point in time that contains a high-level picture of a company's assets and liabilities. The goal of a balance sheet is to provide a complete picture of an entity's finances. In situations where a company is owned by multiple parties or publicly traded, it also reports the equity of the company's shareholders. Capital. Capital is a blanket term for all of an individual or company's assets that have financial value. Cash flow. Cash flow is the total, net amount of cash being moved into and out of business. A cash flow statement helps track the cash inflows and outflows, but unlike a balance sheet, it does not include owned assets, only cash and cash equivalents. Cash flow is the net amount of cash that an entity receives and disburses during a period. Consistently maintaining a positive level of cash flow is necessary for an entity to remain in business. Cost of goods sold. It is the accumulated total of all costs used to create a product or service that has been sold. These costs include materials, labor, and overhead and exclude distribution and sales costs. Creditor. A creditor is an entity, person or institution that extends credit by giving another entity permission to borrow money intended to be repaid in the future. Current assets. Assets that fall under this category can be liquidated within a one-year time frame. Accounts receivable, inventory, and cash would all be considered current assets for a business. Current liabilities. Just as current assets are assets that are typically liquidated within a year, current liabilities are liabilities that are generally paid within a year. Depreciation. Depreciation is a method of tracking the cost of an asset over its lifetime of use. Accountants use depreciation to account for the use of an asset and the decline in its value over time. For instance, if you bought a $1,000 TV for your conference room in 2020, it would not be worth that same amount in 2025. The loss of value for depreciable assets results in tax savings because each year's depreciation amount can be treated as an expense. For example, if that $1,000 TV is worth $920 in 2021, that would count as an expense of $80. Diversification. Diversification involves spreading capital over various investments, thereby reducing risk. Dividends. Dividends are any company earnings paid out to shareholders or investors. In the case of publicly traded companies, this number is determined by a board of directors. Equity. Equity is the value that an investor or shareholder would receive if the company liquidated all assets and paid off all debts. For example, if a company had assets of $1 million and debts of $500,000, it would have equity of $500,000. Equity. Equity is the term used to denote ownership in a business. Expense. It is the reduction in the value of an asset as it is used to generate revenue. Expenses. Expenses are all of the costs of doing business and can generally be divided into 4 different categories: fixed, variable, accrued, and operational. Fixed assets. Fixed assets are held by a company or individual for a long-term period, more than a year. Fixed assets include property, buildings, residences, and major business equipment. Fixed cost. Fixed costs are costs that do not change based on any other factors. For instance, rent is a fixed cost as it does not increase or decrease based on any outside factors related to the business. Fixed expenses. Fixed expenses occur regularly and are the same amount from one billing cycle to another, such as a mortgage payment. If your phone bill or internet charge is the same from month to month, that is a fixed expense, too. General ledger. A general ledger is the cornerstone of a company's accounting system. It contains a list of every account used in the business, which tracks the transactions for that account. The company's complete financial transaction history is the general ledger. Generally accepted accounting principles. Created by the accounting industry, these are the rules and guidelines recommended for businesses when reporting all of their financial data. Gross profit. Gross profit refers to the total revenue minus the cost of goods sold. Income statement. An income statement is one of the main financial statements used by businesses. It shows revenues and expenses over a period and provides information on how revenues turn into net income and net profit. Insolvency. The situation where the liabilities of a person or firm exceed its assets. However, in simple terms, if a company or individual is insolvent, there is not enough cash to pay all of the debts or meet current financial obligations. Interest. Interest is the cost of money borrowed. Inventory. Inventory refers to the cost of the goods the company intends to sell to its customers. Common items that contribute to inventory are raw materials used for production and produced goods that have yet to be sold. Liabilities. Any debt owed or any financial obligation that has yet to be paid is considered a liability. It is a legally binding obligation payable to another entity. Liabilities are incurred to fund the ongoing activities of a business. Liquidity. An asset's liquidity refers to how fast it can be bought or sold at a fair price. Highly liquid assets sell faster and have an easier time being turned into currency. Liquidity ratios. Liquidity ratios show how liquid an organization is, whether it can pay all its bills on time. They include the current ratio and quick ratio. Long-term liabilities. Any liability with a repayment period over 1 year is a long-term liability. Examples include a car payment and a multi-year lease on a building or residence. Net income. Net income, also known as net earnings, is the total sales or revenue for service-based businesses minus the cost of goods sold and any indirect sales expenses. It is used as an indicator of a company's profitability. Net income. It is the excess of revenues over expenses. This measurement is one of the critical indicators of company profitability, along with gross margin and before-tax income. Net loss. Net loss is the amount of money lost by a person or business during a specified period. Net profit. Net profit is the amount of money a business has made once expenses have been deducted from revenues. Overhead. Overhead refers to any business expenses that are ongoing and not directly related to the creation of goods or providing services. Understanding this number helps a company budget and set prices for goods and services. Owner's equity. The amount of equity or ownership someone has in a company is owner's equity. Payroll. Payroll is the total cost of all employee compensation. A majority of payroll is made up of employee wages, but also includes the cost of employee benefits and payroll taxes. Present value. Sometimes called the discounted value, present value is the current value of a future sum of money or stream of cash flows, given a specified rate of return. In other words, if someone gave you $1,000 today, the money's present value is worth more than if that same person gave you $1,000 years from now, because receiving it at a later date keeps you from investing it and increasing its return. Profit and loss statement. The profit and loss statement, also known as an income statement, summarizes the revenue, expenses, and costs that a company incurs over a period. This statement is also known as the statement of activities in not-for-profit organizations. Profit is the positive amount remaining after subtracting expenses incurred from revenues generated over a designated period. Profitability ratios. These are ratios used by businesses to show their returns on investments, ROI, including profit margin, return on assets, and return on equity. Return on investment, most often called ROI, a return on investment measures how profitable an investment is for a company or entity. A high ROI indicates a highly successful investment, while a low ROI indicates a less successful investment. Return on investment, ROI. This unit of measurement is used to identify how much money was gained on a particular venture based on the original investment. For instance, if a company spent $100 on a marketing campaign and had a net profit of $1,000, the ROI would be $900, the difference between the two. Sometimes, this number is expressed in percentage form. Return on investment. This is a measurement designed to evaluate the ability of a business to generate income. Revenue. Revenue refers to the total income generated by goods sold or services rendered by an entity. Revenue may also be referred to as gross sales or top line, because revenue is shown on the top line of an income statement. Shareholders. Individuals who own shares of stock in a company are its shareholders. Statement of retained earnings. This financial statement is the earnings a company retains, minus the dividends paid from those earnings to the company's shareholders. Stockholders equity. Stockholders equity, also known as owner's equity or shareholders equity, is the amount of value and assets that a stockholder is entitled to after a company pays all its debts and liquidates all its assets. Trial balance. A trial balance is a bookkeeping worksheet where the total balance of all ledgers is kept. The trial balance contains 3 columns, one that names the account, a debit column, and a credit column. The debit and credit columns must balance one another when the sheet is completed. Variable cost. Variable costs are any costs that change based on how much a company is doing business. For instance, raw materials are a variable cost because the more goods a company sells, the more raw materials they need to purchase. Variable expense. A variable expense is an expense with an amount that changes from one billing cycle to the next. Personal examples include electric, gas, and water bills. A typical variable expense in business is labor costs. Working capital. This number indicates the amount of money a company has to work with, and it's calculated by subtracting current liabilities from current assets.